Right now, millions of retirees are walking straight into a massive tax trap, and most of them have absolutely no idea it is happening. Here is why. The IRS changed the required minimum distribution age to 73, but it quietly left the most powerful tax loophole in the entire retirement code locked at exactly age 70 and a half. If you wait until 73 to start thinking about this, you will permanently lose access to a completely legal strategy that can eliminate your Medicare surcharges, shield your Social Security from taxation, and drain your IRA without owing a single dollar in taxes. The confusion surrounding this is completely understandable. For decades, age 70 and a half was the undisputed milestone for retirement planning. It was the precise moment the IRS forced you to start pulling money out of your retirement accounts and paying taxes on every distribution. Then recent legislation, first the Secure Act and then Secure 2.0, pushed that mandatory withdrawal age to 72, then 73, and eventually it will reach 75. Almost overnight, everyone stopped paying attention to age 70 and a half. But the IRS quietly kept 7 extraordinarily powerful tax strategies anchored to that exact half birthday. And I have watched countless hardworking people hand thousands of dollars to the government, money they legally did not owe, simply because they did not know these rules still exist in 2026. Today, we are going to walk through all 7 specific things the IRS allows you to do starting at age 70 and a half that most retirees never use. I am going to show you precisely how each one works, how to layer them together for maximum benefit, and how to protect your life savings from taxation that is entirely avoidable. We are going to start with a strategy that can immediately put cash back in your pocket by reducing your healthcare costs. And I have saved the single most powerful, counterintuitive estate planning secret for the very end. Strategy 1, the IRMAA Assassin, protecting your Medicare premiums. Let us begin with something that catches almost every retiree completely off guard: Medicare Part B and Part D surcharges. These are officially known as IRMAA, the Income-Related Monthly Adjustment Amount. When you enter your 70s, your income directly determines how much you pay for healthcare coverage. If your income crosses certain IRS thresholds by even $1, your Medicare premiums can instantly double or triple for the entire calendar year. Here is how this trap is set. You have spent decades diligently contributing to a traditional IRA or 401k. That money has grown tax deferred, which was fantastic while you were working. But now that you are retired, every dollar you pull out of those accounts to cover living expenses, or eventually to satisfy your required minimum distributions, is treated as ordinary income. That income spikes your adjusted gross income, also known as your AGI. And the IRS uses your AGI to determine your Medicare premiums. If your IRA withdrawals push your income over the first IRMAA threshold, you do not just pay a little more. You are hit with what amounts to a cliff penalty. One extra dollar of income can trigger thousands of dollars in additional Medicare premiums for the entire year. It feels like a punishment for being a disciplined saver your whole life. This is where the payoff comes in, and it is unlocked at exactly age 70 and a half, specifically through what is called a qualified charitable distribution, or QCD. At 70 and a half, regardless of the new RMD age of 73, you are legally permitted to transfer money directly from your traditional IRA to a qualified charity. You can move up to $105,000 per year, adjusted annually for inflation. The genuine magic of this strategy is that the money transferred this way never appears on your tax return. It does not show up in your adjusted gross income. It is as though it never left your IRA, at least as far as the IRS is concerned. Consider a retiree named Robert. Robert is 71 years old and wants to donate $10,000 to his local food bank this year. If Robert takes $10,000 out of his IRA, deposits it in his checking account, and then writes a personal check to the food bank, that $10,000 is added directly to his AGI. That income spike pushes him over the IRMAA threshold, and suddenly his Medicare premiums jump significantly for the entire following year. But if Robert uses a QCD, the money flows directly from his IRA custodian to the food bank. His AGI remains exactly the same as if he never touched those funds. He sidesteps the Medicare surcharge entirely. Did you know that a substantial percentage of retirees currently paying IRMAA surcharges are doing so completely unnecessarily? They have charitable intentions and they hold IRA funds, but because they are not using the 70.5 QCD rule, they are inflating their income without reason and paying stealth taxes on their healthcare every single month. Strategy 2, the Social Security tax rescue. If there is one tax that makes retirees angrier than any other, it is the federal tax on Social Security benefits. You contributed to the system with after-tax dollars throughout your entire working career, and now the government wants to tax you again when it hands those benefits back. The setup here revolves around a deeply confusing formula the IRS uses called provisional income, sometimes also referred to as combined income. This is the figure that determines whether your Social Security benefits are tax-free, 50% taxable, or up to 85% taxable. To calculate it, the IRS takes half of your annual Social Security benefit, adds your ordinary income, adds your capital gains, and even includes tax-exempt municipal bond interest. All of it counts. Here is the critical tension point for anyone over 70 and a half. You may be intentionally holding off on touching your IRA until you are legally required to at age 73. But perhaps you need a little extra cash, or you want to begin supporting your church or your alma mater. The moment you take a standard distribution from your traditional IRA, you are pouring fuel onto your provisional income calculation. For a married couple filing jointly, if provisional income falls between $32,000 and $44,000, up to 50% of your Social Security becomes taxable. If it crosses $44,000, up to 85% becomes taxable. Let me be completely clear about something. In 2026, $44,000 is not a large income threshold. Nearly any meaningful IRA withdrawal is going to push you into the 85% taxation tier. You end up paying a double tax, ordinary income tax on the IRA withdrawal, and then that same withdrawal forces additional taxation on your Social Security benefits. The payoff is once again unlocked at age 70 and a half. By routing charitable giving through a QCD rather than a standard IRA distribution, you completely bypass the provisional income formula. Because a QCD is excluded from your adjusted gross income, it is also excluded from your provisional income calculation. You can move significant amounts of money out of your IRA to support causes you care about. And the IRS effectively ignores the transaction when computing how much of your Social Security to tax. Think about what that means in concrete terms. If you withdraw $20,000 from your IRA through a regular distribution to donate to charity, that $20,000 could pull 85% of your Social Security into the taxable realm, costing you thousands in completely unnecessary taxes. If you make that identical $20,000 transfer as a QCD, your Social Security remains fully protected. You get to be generous without the federal government penalizing you for it. Strategy 3, the double dip deduction, the standard deduction loophole. Let us now address how the tax code actually functions for the average retiree today, because it has changed significantly in recent years. Whenever you file your federal tax return, you reduce your taxable income by either claiming the standard deduction or itemizing your deductions. Because recent tax legislation dramatically increased the standard deduction and added a meaningful additional deduction specifically for taxpayers over age 65, the standard deduction for a married couple in 2026 is exceptionally generous. This creates a significant tension. Because the standard deduction is so large, the vast majority of taxpayers no longer itemize their deductions. And if you do not itemize, you receive absolutely zero tax benefit for writing a personal check to charity. None whatsoever. Let me repeat that because it matters. If you write a check from your personal bank account to a charity and you take the standard deduction, the IRS gives you zero tax relief for your generosity. You are giving away after-tax dollars. You paid income tax on that money when you earned it, and you receive no deduction when you donate it. But at age 70 and a half, the IRS hands you the ability to double dip in a way that is completely legal and remarkably effective. When you execute a qualified charitable distribution, the money exits your IRA without ever being counted as taxable income. It is completely tax-free to the charity because it never enters your taxable income stream in the first place. It is functionally equivalent to receiving a massive tax deduction without actually having to claim one. And here is the brilliant dimension. You still claim the full inflated standard deduction on your tax return. Here is the math made clear. Suppose your combined standard deduction is $32,000 this year. You also want to give $15,000 to your church. If you write the check from your checking account, you receive your $32,000 standard deduction and nothing else. The $15,000 contribution delivers zero additional tax benefit. If you use a QCD from your IRA at age 70 and a half, you still receive your full $32,000 standard deduction to shelter your other income. Additionally, you successfully avoided paying taxes on the $15,000 withdrawn from your IRA. You have effectively shielded $47,000 of wealth from taxation in a single tax year. Why are so many retirees missing this entirely? Because their CPAs and tax software simply ask, "Did you make any charitable contributions?" They do not proactively say, "Wait, you are now 70 and a half. You should stop writing checks from your bank account and start directing charitable giving through your IRA." You have to be the one to initiate this. Nobody will do it for you. Strategy 4, the pre-RMD deflation strategy. Let us now shift focus to the future, specifically to the ticking financial time bomb that is your required minimum distribution at age 73. The setup begins with a psychological trap that captures nearly every retiree. Because the IRS pushed the RMD age back to 73, most people feel like they have been handed a gift. They think, great, I can simply let my traditional IRA grow tax-deferred for a few more years. I will live on my taxable accounts and let the retirement account continue compounding. Here is the tension, and it is severe. By allowing your IRA to grow completely unchecked until age 73, you are building an enormous and unavoidable tax liability. When 73 arrives, the IRS requires you to withdraw a specific percentage of the inflated balance every single year, whether you need the money or not. Because the balance has grown so large, the mandatory withdrawals will be substantial. These forced distributions stack directly on top of your Social Security benefits, any pension income, and your investment returns. Suddenly, you can find yourself pushed into the 24%, 32%, or even higher marginal tax brackets. You have lost control of your own income. Have you actually calculated what your RMD will look like at age 73? If you have a $1 million IRA, your first required distribution will be approximately $37,000. By the time you reach age 80, if the account has continued growing, that forced annual withdrawal could be $60,000 or $70,000 every year, whether you want it or not. The payoff is what I call the pre-RMD deflation strategy, and you can begin implementing it at exactly age 70 and a half. Instead of waiting for the balloon to rupture at 73, you can use QCDs to intentionally and strategically reduce the size of your traditional IRA before the government forces your hand. Every dollar you transfer to a qualified charity through a QCD between ages 70 and a half and 73 is a dollar that permanently escapes the RMD calculation going forward. You are systematically reducing the taxable foundation of your retirement portfolio. By doing this proactively, when you finally reach age 73, your IRA balance is meaningfully lower. Your mandatory withdrawals are smaller. Your taxable income stays in the lower brackets. You avoid triggering the IRMAA Medicare surcharges we discussed earlier, and you retain genuine control over your financial life in retirement. This requires a specific shift in thinking. You must stop viewing age 73 as the starting line for IRA planning and recognize that age 70 and a half is your true window of opportunity, your moment to release the pressure before the tax balloon bursts. Strategy 5. The widow's tax trap avoidance. This next point is perhaps the most difficult to discuss emotionally, but it is absolutely essential for protecting your family. We need to have an honest conversation about what happens to your spouse's tax situation when one partner passes away. The setup is a reality every married couple must confront. Most married couples hold the majority of their savings in traditional pre-tax retirement accounts. While both spouses are living and filing taxes together, the married filing jointly brackets are wide and relatively generous. It takes a significant amount of combined income to push a couple into the higher marginal brackets. The moment one spouse passes away, everything changes dramatically. The surviving spouse typically inherits the deceased's IRA. They now control the same total amount of money. They face similar living expenses, particularly around housing, property taxes, and healthcare. But when tax time arrives, they must file as a single taxpayer. The tax brackets for single filers are brutally compressed. The exact same income that kept a married couple comfortably in the 12% or 22% bracket will often force a single widow or widower into the 24% or 32% bracket. This is commonly known as the widow's penalty, a devastating stealth tax that strikes people during the most emotionally vulnerable period of their lives, and it compounds further. Because the survivor now holds both IRAs, their required minimum distributions at 73 will be significantly larger, all taxed at those aggressive single filer rates. The payoff relies on aggressive use of the 70.5 rules while both spouses are still alive and healthy. If you wait until 73 to begin this strategy, you have compressed the window for managing this risk. But starting at 70.5, a married couple can use QCDs to systematically draw down their traditional IRA balances, while still benefiting from the broader married filing jointly tax brackets. If you plan to give to charities, tithe to your church, or fund educational scholarships, you must execute that giving exclusively from your pre-tax IRAs while you still have the tax advantage of filing jointly. By strategically reducing the traditional IRA while both spouses are living, you preserve your Roth IRA and taxable brokerage accounts, which receive a step up in basis at death for the surviving spouse. You are intentionally building a financial shield for whoever is left behind. When the inevitable happens, the surviving spouse inherits a much smaller traditional IRA. Their forced RMDs are manageable, keeping them out of punitive single-filer brackets. And they have tax-free Roth money available for any unexpected needs. Do not leave a ticking tax bomb for your spouse. Use the 70.5 rules to address it together while you both still can. Strategy 6. The lifetime income loophole. Charitable gift annuities. Before we reach the 7th and final strategy, which I believe is the single most powerful wealth transfer secret in the entire tax code, I need to share one more that addresses a concern almost every retiree carries. The concern is fear. The setup is deeply human and completely understandable. You spent 40 years building your retirement nest egg through sacrifice and discipline. You want to be generous, but you are terrified of depleting those savings. You think, if I give this money away to a charity, it is gone forever. What if I need it later for long-term care or unexpected medical expenses? This fear paralyzes retirees. It prevents them from taking advantage of any of the QCD strategies we have just discussed. They hold on to the IRA protectively, only to eventually get crushed by the taxes we covered in the earlier strategies. But thanks to a specific provision within the Secure 2.0 Act, there is an extraordinary solution that addresses this fear directly. Once you reach age 70 and a half, The IRS now allows you to make a one-time qualified charitable distribution of up to $53,000 adjusted for inflation directly from your IRA to what is called a split interest entity. The most commonly used and most powerful version is a charitable gift annuity. Here is how this counterintuitive strategy actually works. You transfer $53,000 from your IRA directly to a qualified charity. The funds leave your account tax-free under the QCD rules. They do not count as income. They do not trigger IRMAA surcharges, and they permanently reduce your future RMD calculation. But instead of the charity simply accepting the money and sending you a thank you note, they enter into a legally binding contract with you. In exchange for your contribution, they agree to pay you a guaranteed fixed income stream for the remainder of your life. Read that again carefully. You are moving money out of your highly taxed traditional IRA, transferring it to a charitable organization, and in return, you are purchasing a lifetime income stream, essentially a private pension funded by the charity. By acting near the 70.5 threshold, rather than waiting until your mid-70s or later, you immediately eliminate a substantial chunk of taxable IRA while simultaneously securing a predictable, reliable cash flow you cannot outlive. When you eventually pass away, whatever remains of that original contribution stays with the charity to advance their mission. It is a genuine win on every dimension. You fulfill your desire to support a worthy cause. You dramatically lower your taxable IRA balance and future RMD obligations. And you completely eliminate the fear of giving away money you might someday need. Because that money is now paying you a guaranteed income for the rest of your life. Strategy 7. The grand payoff. The anti-tax estate transfer. We have now arrived at the most powerful strategy of all 7. If you remember only one concept from this entire presentation, let it be this one. It is about your legacy, your children, and keeping your accumulated wealth out of the hands of the federal government after you are gone. The setup begins with a catastrophic change the IRS implemented several years ago. Under the old rules, when you passed away and left a traditional IRA to your children, they could stretch the mandatory tax withdrawals across their entire lifetime. They could take small, controlled distributions each year, keeping their tax burden minimal while the remainder of the account continued compounding. It was one of the most effective intergenerational wealth transfer strategies available. The Secure Act permanently ended the Stretch 1RA strategy. Under the current rules, when your adult children inherit your traditional IRA, they are legally required to completely liquidate the account within 10 years of your death. There is no flexibility, no exceptions for most adult beneficiaries. Now think about the timing of this requirement. When you pass away, your children will likely be in their 40s, 50s, or possibly early 60s. These are typically their peak earning years, the period when they are already paying taxes at the highest marginal rates of their careers. Suddenly, on top of their salaries and their own retirement contributions, they are forced to drain your entire traditional IRA over a compressed 10-year window. That inherited taxable income stacks directly on top of everything else they are earning. Depending on the state they live in and the size of the IRA, your children could realistically lose 40% or more of your accumulated life savings to combined federal and state income taxes. It is a wealth destruction event in the truest sense. You spent your entire life saving, denying yourself luxuries, postponing gratification, only for the IRS to effectively confiscate nearly half of it, simply because of the type of account in which it was stored. The payoff is what I call the anti-tax estate transfer, and it depends entirely on pivoting your strategy the moment you turn 70 and a half. Most retirees have charitable intentions embedded somewhere in their estate plan. Their will or trust document typically reads something like, "Upon my death, donate $100,000 to my university and divide the remainder equally among my children." If you wait until you die to fulfill your charitable goals, you are making a costly tax error that will affect your family for years. Starting at 70 and a half, you need to completely rethink the sequencing of your estate plan. Execute all of your charitable giving while you are alive using qualified charitable distributions directly from your traditional IRA. Do not leave it to your estate to handle after you are gone. Every dollar you direct to charity through a QCD is a highly taxed dollar that is permanently removed from your estate before it can become a burden for your heirs. By fulfilling your charitable goals with pre-tax IRA funds during your lifetime, you intentionally preserve your superior assets for your family. Your children inherit your Roth IRA, completely tax-free under current law. They inherit your taxable brokerage accounts and any real estate you own, which receive a step-up in cost basis at your death, meaning they can sell those assets and owe zero in capital gains taxes. You are executing a sophisticated tax arbitrage that most families never consider. You are deliberately routing the most heavily taxed asset, the traditional IRA, to a tax-exempt charitable organization using the 70 and a half QCD provision. Simultaneously, you are preserving the most tax-efficient assets, Roth accounts and stepped-up brokerage holdings, for your family. This straightforward shift in the sequencing of your giving can transfer hundreds of thousands of dollars directly from the IRS into the hands of your children and grandchildren. It is perhaps the most powerful act of financial protection and legacy planning available to any retiree in the current tax environment. Summary: your 7-point action plan. To protect everything you have built, start by looking past the conventional wisdom. Here is what you need to remember. First, do not wait until age 73 to begin planning around your IRA. Age 70 and a half is your true planning window, the moment your most powerful tools become available. Second, the qualified charitable distribution is your primary weapon against IRMA, Medicare surcharges, and Social Security double taxation. Use it deliberately and consistently. Third, you can secure guaranteed lifetime income while simultaneously shrinking your taxable estate through a charitable gift annuity funded by a one-time QCD, eliminating the fear of giving away money you might someday need. Fourth, begin deflating your traditional IRA intentionally between ages 70 and a half and 73 to protect your surviving spouse from the widow's tax penalty and to spare your children from the devastating 10-year forced liquidation rule. You worked too hard and sacrificed too much to let an incomplete understanding of the tax code quietly drain your retirement savings in your final chapters. I know this is a significant amount of information to absorb, and every person's financial situation carries its own unique variables. I want to hear how these rules are affecting your planning right now. Scroll down and share your experience with IRA withdrawals in the comments. Or tell me which of these 7 strategies you are planning to implement this year.